The Chinese tech sector is down 63%, reaching valuation lows we haven't seen in a decade. I believe recent government and economic policy factors are acting as a strong catalyst to reverse this trend, and that's why I'm buying Chinese tech. In this video, I'm going to briefly walk through the causes of this decline, the catalyst to reverse this, and specifically what I'm buying to hopefully profit from this reversal. So let's get into it. For me, two words stand out as the main reasons for the sell-off in Chinese stocks: power and control. Starting with the Communist Party's common prosperity reforms of 2020 and 2021, the party moved to limit the power of technology companies they perceived as monopolistic and potentially a threat to the hegemony of the Communist Party or its legitimacy. New limitations or controls were spread throughout the sector, from limits on the amount of time kids could play video games online to more stringent regulation and forced disclosures of user data. The two most noteworthy events were the suspended Ant Financial IPO and the fallout from Didi's US listing. In the former, 2 days before Ant Financial attempted to raise $34 billion in an IPO, what would have been the biggest amount ever, the Chinese government pulled the plug. The company had been under scrutiny for numerous things, such as its subsidiary Alipay's pulling money away from the traditional state-controlled banking system. But the final straw was negative comments made by founder Jack Ma against the heavy hand of the Communist Party and its regulators. President Xi Jinping reportedly pulled the IPO personally before Jack Ma, one of the richest men in the world, was basically disappeared for 3 months before only reappearing in the so-called hostage video. Creepy. The next event was Didi's June 2021 New York Stock Exchange IPO, which ran afoul of the Communist Party over things like Chinese user data falling out of their direct control and influence. 4 days after the IPO, the Cyberspace Administration of China ordered the app pulled from all app stores. Not subtle, and fines and probes ensued. The US reacted to this with the Holding Foreign Companies Accountable Act in order to combat foreign companies from withholding relevant shareholder disclosures at the urging of their government overlords. And as a result, a large swath of Chinese companies are in the process of delisting from US stock exchanges. And so began the great fire sale of Chinese stocks. Now, the Chinese economy has been on a weak footing as of late. From cooling domestic consumption, strict lockdown conditions in major economic centers, a chaotic housing market, etc. And the Chinese government is now under pressure to strengthen growth. President Yi has announced support and stimulus to return the country to its growth objectives, particularly in infrastructure spending. The Politburo followed this up with more tech-friendly speak and plans to unveil specific measures to support the healthy and normal development of the sector. While I definitely have concerns that these specific measures may just be lip service, my view is that this has the potential to mark the end of the Communist Party's witch hunt against the tech sector, having realized its importance to domestic growth objectives. Moreover, Chinese big tech has likely learned its lesson here and will chart a wiser course, more careful of attracting the ire of the government. And in big news today, China announced that it will be easing lockdown conditions in Shanghai, which will likely be the start of an about face as the nation begins to move forward. This will undoubtedly bring some optimism to the Chinese stock market. On the US side, the bad news is still there, such as the SEC playing down prospects of Chinese firms to maintain their US listings, adding JD and Baidu to its delisting watch list, and announcing an investigation into the Didi IPO. Obviously, more news like this could keep coming in, but I believe most investors have little faith that Chinese firms will remain listed in the US, and that the worst case, and most likely outcome in my opinion, is already priced in. Now, I'm not a big fan of trying to time markets, nor would I consider myself a value investor, but buying good companies with impressive growth at their absolute peak of being hated, I think makes a lot of sense, especially when the ruling party seems to be in the early days of transitioning back to business as usual. If I'm right, the Chinese government's overhang on the sector will progressively diminish, and the chatter out of the SEC will become increasingly irrelevant, while the shares have lots of headroom to their previous all-time highs. If I'm wrong, I think valuations at decade lows and strong growth prowls will help serve as a floor to current prices, making for a strong risk-reward mix. Now, I think there's a lot of quality Chinese growth companies at solid valuations here. For example, Alibaba, which I consider sort of a Chinese proxy for Amazon, is forced to grow revenue at nearly an identical rate to its American peer. The difference here is that Alibaba trades at half the valuation. That said, there is still risk that individual Chinese companies will find themselves with a bullseye on them, so I prefer a basket approach to help mitigate single stock risk. Moreover, my experience and likely strength is in Western companies, so paying lip service due diligence probably doesn't offer the same return on effort in building a basket of Chinese stocks that I'd want to invest in. Instead, I'm going the ETF route. Two good options for investors here are BlackRock's iShares Hang Seng Tech ETF. This fund tracks the 30 stocks that make up the Hang Seng's Tech Total Return Index. And CraneShares CSI Internet ETF, which tracks the CSI Overseas China Internet Index. Both provide exposure to a broad swath of high-growth Chinese technology companies, but importantly, all names are large cap with established market share in their specific industries and strong growth. I want to make a bet on the Chinese turnaround and not speculate on small cap market hopefuls. In the end, I decided with the Crane Shares ETF, or as I like to call it, the Queeb, as I thought it had potentially a bit more juice from more up-and-coming Chinese tech companies, while potentially offering a bit more diversification. It is more expensive than the iShares option with a management fee of 0.7% versus 0.25%, but it's domiciled in the US, which I think adds that extra little bit of security. On the return front, the Queeb was hit pretty hard, but I just think that creates a great entry point with a lot of upside. Alright, so those are my thoughts on the Chinese tech sector. Admittedly, there's a lot of moving parts here as the regulatory situation evolves in China and the US. But as a long-term growth investor, I want to construct portfolios with companies built for the future and take advantage of market disruptions to get good entry prices. And right now, I think Chinese tech ticks all those boxes. With US stocks facing an increasingly negative outlook, taking a shot on the wildies not only provides the potential for solid growth, it may end up being the more defensive strategy. Alright, thanks for watching, and please hit the like and subscribe buttons for more market insight and entertaining takes on the business world. I'm Ryan, and thanks for tuning into Market Lab.